Welcome to this explainer. Today, we're going to fundamentally change how you read financial statements. We're looking right past traditional accounting rules, cutting through all that noise and learning how to measure what a company's assets are actually worth. Honestly, if standard financial reports have ever felt like they're kind of hiding the real story from you, you are exactly in the right place.
Here's our quick roadmap for today's journey. We'll start with the rule of sound investing, move on to reading basic accounting statements, look at the historical cost problem, dive into assets in place and growth, rebuild things with the financial balance sheet, and finish up with why you should always use updated information. Let's get to it.
Okay, let's dive into this. Section 1, the rule of sound investing, price versus value.
You know, Oscar Wilde actually hit the nail on the head when it comes to modern markets. He said, "A cynic is one who knows the price of everything, but the value of nothing." Today, we actually see this play out as the bigger fool theory of investing. People will completely ignore intrinsic value, just hoping there's a bigger fool out there who's going to pay a higher price later on. It is an incredibly dangerous game of musical chairs.
And that brings us to the ultimate postulate, the golden rule of sound investing. You should literally never pay more for an asset than what it is truly worth. Now look, if you're buying a painting or a cool sculpture, sure, aesthetics and feelings are really all that matter. But financial assets, they are completely different. You shouldn't be buying stocks or bonds for emotional reasons. The price you pay for any financial asset absolutely has to be backed up by reality. And in this case, reality means the expected future cash flows that asset is going to generate. That is the anchor for everything we're going to talk about today.
Section 2, reading basic accounting statements, the fundamental information.
Right, so to find that true value, we have to gather reality. But we want to keep in mind the principle of parsimony, meaning we really only want to use the inputs we absolutely need. Our starting line is the balance sheet. It perfectly summarizes what the firm owns, its assets, and how it paid for them using a mix of debt and equity. It categorizes everything from long-lived stuff like buildings to short-lived current assets like inventory. But here's the crucial thing to remember. The balance sheet is only a static snapshot. It's just a single moment in time.
Next up, we've got the income statement. While the balance sheet tells us what a firm owns, the income statement answers how profitable those assets are over a specific stretch of time, like a quarter or a year. It walks us all the way down from gross revenues at the very top, subtracting the operating and financial expenses, straight down to net income at the bottom. It's totally dynamic over a period, which is a big contrast to that static balance sheet snapshot.
Section 3, the historical cost problem, the limits of accounting.
So while standard accounting statements are great at categorizing things, there's a massive catch we need to talk about. Accountants and valuation experts have vastly different objectives. Accountants are bound by these very rigid rules that can honestly distort reality for us as investors. First off, they have an abiding belief in book value. That means they focus on historical cost, literally the original price paid for an asset, instead of what it's actually worth today. Second, they demand that future benefits be precisely quantifiable before they'll even record an asset. And third, they are obsessed with conservative estimation. If there's two ways to value an asset, accounting rules almost always say, use the lower number.
This creates a stark contrast between rigid accounting rules and real financial analysis. Think about it like this. Standard accounting statements are like driving while staring in the rearview mirror. Accountants are just trying to meticulously measure the immediate past. But as investors, we need to look through the windshield. Real financial valuation is fundamentally forward-looking.
Section 4, assets in place and growth, the missing pieces.
Let's look at these two concepts side by side. Over on the left, we have assets in place. These are the existing investments that are generating cash flows right now. Factories, current inventory, stuff like that. Standard accounting actually does a decent job recording these, though, again, usually at historical cost. But look at the right side. We have growth assets. This is the expected value that's going to be created by future investments. For high-growth firms, think major software companies or pharma giants that rely heavily on internal R&D, standard accounting completely ignores these growth assets. Because of those rigid rules, accountants literally assign their massive future potential a value of 0. No way, right?
So let me just ask you, the focused learner. If standard accounting completely ignores future growth and stubbornly measures current assets based on outdated historical costs, what are the actual questions we need answers to? How do we figure out a company's true value and bypass all these limitations?
Now, what's really interesting about this slide is how it breaks down the truth. We just need to ask 4 specific questions. On the asset side, what are the assets in place, how valuable are they, and how risky are they? And crucially, what are the growth assets and how valuable are they? Then, flip to the financing side. What is the value and risk of the debt, and what's the value and risk of the equity? Notice the shift here. The focus is entirely on current value and forward-looking risk, not historical cost.
Section 5. The financial balance sheet, rebuilding the model.
By answering those 4 questions, we can completely rebuild the old accounting model. This right here is the financial balance sheet. Instead of a laundry list of depreciated historical costs, the asset side is beautifully broken down into exactly what actually matters, the true value of assets in place plus the true value of growth assets. And this is balanced perfectly against how the firm finances those expected future cash flows, through debt and equity. We have finally captured the single largest component of value that traditional accounts just leave out, future growth.
But as we look at this elegant new framework, I really want to share a direct, totally empowering reminder from our source material. Quote, "Valuation models don't value companies, you do." In today's world, our problem is definitely not a lack of information. It's way too much information. Your ultimate job as an investor is separating the signal from all that noise. Your judgment is what makes this financial balance sheet actually work.
Which brings us to Section 6. Always use updated information. Actionable insights. Okay, here is a classic rookie mistake you absolutely must avoid. Companies release their official annual reports, the 10Ks, just once a year. By the time you sit down to value a company in, let's say, August, that report is basically a historical artifact covered in cobwebs. Relying on data that stale for a rapidly changing firm, it pretty much guarantees you're going to drastically undervalue them.
So, the crucial point is, you have to actively adjust your inputs to get a read on a company's true current value. Step 1. Abandon the stale annual reports. Step 2. Go grab the firm's most recent quarterly reports, the 10Qs. Step 3. Aggregate the numbers over the most recent 4 quarters to calculate what we call trailing 12-month revenues and earnings. This is a simple hack, but it gives you fresh, highly relevant inputs for your valuation models. It captures that recent exponential growth that an old annual report would completely miss.
Well, that brings us to the end of our journey today, and I want to leave you with this really provocative thought. If sound investing is based purely on expected future cash flows, how much of a company's stated accounting value, its historical costs and conservative estimates, is really just a comfortable illusion of its past? I hope this explainer has given you the skills to look right past standard documents and apply a powerful new financial lens to your own investments. Thanks so much for learning with me today, and keep asking the right questions.